Imagine you are 58 years old. You have been saving for retirement your entire adult life. And one afternoon, you log into your brokerage account and you see it. A fund paying 11% every single year. Monthly income, steady distributions, professional management. Everything your financial future was supposed to look like. So you move $200,000 into it. And for the first year, it is perfect. The money hits your account every single month, like a paycheck you never have to work for. Then year 2 comes. The distributions start shrinking, the fund value starts dipping, and by year 3, you have lost $40,000 in principal, money you can never earn back because you are 3 years closer to retirement, and the market does not care about your timeline. That is not a hypothetical horror story. That is the math hiding inside funds that millions of Americans are choosing right now, specifically because they feel safer than the boring alternative. And today on Gigi Invests, we are going to run the real numbers, not the yield on the brochure, the actual dollars in your account after 3, 5, and 10 years, including what happens when you are near retirement and cannot afford to wait out a recovery. Because the $100,000 gap I mentioned in the title, that's conservative. For some investors, it is worse. And the reason almost nobody talks about it is because the fund that costs you the most looks the most impressive on paper. Stay with me for the next 15 minutes. This might be the most important thing you watch before you touch a single dollar of your retirement savings. If you're new here, welcome to Gigi Invests, where we break down exactly how your money actually works, not how Wall Street wants you to think it works. Hit subscribe so you never miss a video like this one. Let's start with the promise, because it is genuinely attractive. High-yield funds, specifically a category called business development companies, or BDCs, and non-traded REITs have exploded in popularity over the last 5 years, and the pitch is always some version of the same sentence. While everyone else is settling for 4%, you could be earning 11%. Same safety, they imply, you are just being smarter about the structure. And here's what makes this pitch so powerful. It is not entirely wrong. These funds do lend money to real businesses. Real interest is charged. Real distributions are paid, at least in the beginning. The machine is real. The question is never whether the machine exists. The question is what happens when the machine breaks. And to understand that, you first need to understand exactly what you are buying when you buy one of these funds. Strip away the marketing language, and here's what sits inside most high-yield income funds targeting retail investors. They are lending money to mid-sized private companies, businesses that are too large for a small bank loan, but too risky or too complicated to borrow cheaply on Wall Street. These companies need capital. The fund provides it. In exchange, the fund charges high interest, sometimes 10%, 12%, even 15% annually. That interest gets collected, pooled, and passed to you as your monthly distribution. When the economy is calm and every borrower is paying on time, this works beautifully. The brochure is telling the truth. The 11% is real. The problem is the part that happens when one of those borrowers cannot pay. Here's where most investors' eyes glaze over, because the finance industry uses language specifically designed to stop you asking questions. The term is paid-in-kind interest, and it sounds almost reasonable until you understand what it actually means. Imagine a friend borrows you $10,000 at 10% interest. At the end of the year, they owe you $1,000 in interest, but they can't pay it. So instead of calling it a missed payment, you agree to add that $1,000 onto the original loan. Now they owe you $11,000 instead. On your books, you still record $1,000 of income earned this year. You did not receive $1,000. You received nothing, but you wrote it down as income anyway. That's paid-in-kind interest, and it's completely legal. It's standard practice, and it's happening right now inside funds that millions of Americans are invested in. Here's why this matters so much, because under U.S. tax law, a fund structured as a regulated investment company, which most of these are, must distribute at least 90% of its reported income to shareholders every year to maintain its tax-advantaged status. Notice I said reported income, not cash income. So follow the chain all the way through. A borrower cannot pay, the fund records the unpaid interest as income anyway, the tax rule kicks in and forces the fund to distribute 90% of that income, the fund mails you a cash distribution built partly on interest that was never actually collected. You receive real dollars in your brokerage account, but a portion of those dollars were not earned by the fund. They came from the fund's own cash reserves, or in some cases, from new investor money flowing in. Across the industry, recent data shows that paid-in-kind interest now represents roughly 9% of total reported income across these funds on average. At some individual funds, the gap between reported income and actual cash received is staggering. One well-known lender reported $55.9 million in interest income in a single year. The cash it actually received on those same loans? $4.9 million. Less than 9 cents of every reported dollar showed up as real money. And here's what that does to your retirement account specifically, because this is where the competitor comparison breaks down entirely and where your age changes everything. Section 3. The Retirement Trap. Why your age changes everything. Most comparisons between high-yield funds and index funds treat both investors as identical. Same age, same timeline, same ability to wait out a rough patch. But you are probably not a 30-year-old with 35 years to recover. And if you are within 10 to 15 years of retirement, or already in it, the math changes completely. There's a concept called sequence of returns risk, and it is one of the most important and least discussed risks in retirement planning. Here's how it works. If you're still in your accumulation phase, decades from retirement, a market downturn is painful but survivable. You keep contributing, you buy more shares at lower prices. When the market recovers, you recover with it. But if you're near retirement or already retired and you're drawing income from your portfolio, a downturn in your early retirement years is catastrophic in a way that a later downturn is not. Why? Because you're selling shares at depressed prices to fund your living expenses. You're permanently removing money from your portfolio at exactly the wrong time, and that money is never there to participate in the recovery. This is why near-retirement investors often feel drawn to high-yield funds. The steady monthly income feels like a solution to sequence of returns risk. You're not selling shares, you're living off distributions. The principle, in theory, stays intact. Except, here's the problem. That strategy only works if the distributions are genuinely sustainable, if they're backed by real cash income, not accounting entries. And it only works if the fund's principal value stays stable. And, as we just walked through, neither of those things is guaranteed in a high-yield fund when borrowers start struggling. Let's put real numbers on this. Investor A is 57 years old. She puts $200,000 into a high-yield fund yielding 11%. She plans to retire at 67. Over a calm 5 years, she collects $22,000 per year in distributions and reinvests half. But in years 4 and 5, the fund begins cutting distributions as borrower defaults rise. Her annual income drops to $14,000. Her fund's net asset value has also declined 18% due to loan write-downs she never saw coming. She enters retirement with approximately $198,000, barely where she started, after 5 years and significant risk. Investor B, same age, same $200,000, puts it into a broad U.S. total market index fund, no special yield, no monthly distributions. She reinvests all dividends. Over the same 5 years, her portfolio grows to approximately $298,000. The gap at retirement? $100,000. And investor B has that $100,000 in stable, liquid, transparent assets she can draw from at any pace she chooses, with no gates, no quarterly windows, no exit restrictions. That $100,000 difference is not just a number. In retirement, at a safe 4% withdrawal rate, that $100,000 generates $4,000 per year every single year for the rest of your life.
Section 4. The liquidity trap. There is one more piece of this story that almost nobody explains until it is too late. When you invest in a publicly traded stock or index fund, you can sell it any day the market is open. You decide you want your money back, you click sell, and within 2 business days, the cash is in your account. Full stop. Many high-yield funds do not work this way. Non-traded BDCs and non-traded REITs, some of the most popular high-yield products sold to retail investors, have limited redemption programs. In plain English, that means you cannot always get your money out when you want it. A typical restriction looks like this. The fund allows redemptions only during specific quarterly windows, and even during those windows, the total amount the fund will redeem is capped, commonly at 5% of total net assets per quarter. When everything is calm and nobody's rushing for the exits, you would never even notice this restriction. You could own these funds for years without it ever affecting you. But restrictions like this are not written to protect you in calm markets. They are written for exactly one moment when too many people want their money back at the same time. And when that moment arrives, here's what happens. The fund hits its 5% quarterly cap. The exit queue forms. Everyone behind the front of the line is simply stuck, holding a declining asset, watching its value erode, unable to leave while waiting for the next quarter's redemption window to open. This is not a theoretical risk. Earlier this year, net inflows into non-traded BDCs dropped by approximately 40% as investors began pulling back. Several major funds have already cut or suspended their distributions. The line at the exit door is forming, and the door only opens a crack. So you now understand the income that was never real, the retirement math that most comparisons skip, and the exit door that locks when you need it most. But there is still one more hidden cost that almost nobody calculates, and it quietly costs you thousands of dollars every single year without ever appearing on your statement. Section 5. The tax drag nobody mentions. Here is a cost that almost never appears in any high-yield fund comparison, and it is one of the most significant real-world differences between these two types of investment. When a high-yield fund pays you monthly distributions, those payments are typically taxed as ordinary income, the same rate you pay on your salary. If you are in the 22% federal bracket, you owe 22 cents of every distribution dollar to the IRS the year you receive it. Index funds work differently. Most of the gains inside a broad index fund are not distributed to you as you go. They compound internally. When you eventually sell, potentially decades later, those gains are taxed at the long-term capital gains rate, which for most middle-income Americans is either 0% or 15%. So the high-yield fund investor is paying 22% tax on income every single year. The index fund investor may pay 15% or even 0%, and only at the point of sale, after decades of additional compounding on money that would otherwise have gone to the IRS. On a $200,000 investment with an 11% yield, that is $22,000 per year in distributions. At a 22% tax rate, that is $4,840 in annual taxes that the index fund investor simply does not face on the same timeline. Over 10 years, before any compounding effects, that is nearly $50,000 in tax payments that came directly out of the high-yield investor's wealth-building potential.
This is the cost that never appears in the headline yield. It never appears in the fund brochure, but it appears very clearly in your tax return every April. If this is the kind of math you want applied to your own investment decisions, breaking down what a yield actually costs you in real, after-tax, after-fee dollars, subscribe to Gigi Invests. We do this every week, and every video is free.
So what should you actually do? I want to be fair here, because this is the section the competitor skipped, and it is the one you actually came for. High-yield funds are not automatically evil. Index funds are not automatically perfect for every single person in every single situation. The question is never which one sounds better. The question is which one is right for your specific age, timeline, tax situation, and income needs. Here is a simple framework. If you are more than 15 years from retirement, the math overwhelmingly favors a broad, low-cost index fund. You have time. You have compounding. You do not need monthly income. You need growth. Every dollar you hand to a fund in fees, taxes, and phantom income is a dollar that does not compound for 15 more years. A total market index fund or an S&P 500 index fund with an expense ratio below 0.10% is almost impossible to beat over long time horizons, not because it is clever, but because it is honest. It owns real companies with real earnings, charges you almost nothing, and gets out of its own way. If you are 5 to 15 years from retirement, this is the zone where sequence of returns risk starts to matter. A blended approach makes sense for many people. The majority of your portfolio still in broad index funds with a growing allocation towards stability, not necessarily yield, but stability. Short-term treasury funds, I-bonds, high-yield savings accounts, and short-duration bond index funds are all legitimate ways to reduce volatility in your pre-retirement years without the hidden risks we walked through today. And here's the final piece, the one question you should ask before you ever put a dollar into any investment that promises you a yield higher than everything else in the room. Because this question cuts through every brochure, every pitch deck, and every reassuring name on the door. Section 7, the one question that changes everything. Every high-yield promise requires something to be true. A 4% yield from a broad index fund requires U.S. companies to keep generating profits over time. That is a reasonable thing to bet on. It has been true for over 100 years. An 11% yield from a fund lending to private companies requires those companies to keep paying, in cash, not in accounting entries, through every economic cycle, including recessions, rising interest rates, and credit crunches. When you ask, what would have to be true for this to keep working, you force yourself to evaluate the actual risk, not the marketing language around it. Here are the 3 questions to ask about any high-yield fund before you invest a dollar. Question 1. What percentage of this fund's income is paid in kind? This number should be in the fund's quarterly SEC filings. If it is above 5%, understand what you are owning. Above 10% is a serious warning sign. Question 2. What are the redemption terms? If the answer involves quarterly windows and percentage caps, you are holding an illiquid asset. That is not always wrong, but you need to know it going in. Question 3. What is the total return, not just the yield? A fund yielding 11% that loses 8% in net asset value per year is delivering you 3%. An index fund yielding 4% that appreciates 10% per year is delivering you 14%. The yield is one number. The total return is the only number that matters. Here is what I want you to take away from today. The boring index fund does not win because it is clever. It wins because it has nothing to hide. The income is real. The price is set by millions of buyers and sellers every second. The exit is always open, and the fees are almost nothing.
The high-yield fund is not a scam. It is a real machine with a real hidden failure point, and that failure point lands hardest on the investors who can afford it least, the ones closest to retirement. The ones chose it specifically because it felt safer. Chasing yield is not smarter investing. It is a more expensive way to carry risk you did not know you were taking. Your retirement savings deserve better than that. If this video helped you see something you hadn't seen before, please share it with someone who is comparing these two options right now. You might save them tens of thousands of dollars and years of stress. Subscribe to Gigi Invests if you want more of this. Real numbers, real math, no fluff, and no products to sell you. And if you want to know what to look for inside your own 401k's default options, that video is coming next. Make sure you are subscribed so you don't miss it. Until next time, I'm Gigi, and this is what your money actually looks like when you follow it all the way down. Subscribe, share, and check your 401k default fund this week, because now you know exactly what to look for.